Hello, everybody, and welcome to On the Move, presented by Momentum Multifamily. The purpose of this series is to interview industry experts and keep you up to date on everything that's going on in the multifamily world and hopefully help you navigate it. My name is Brendan Gardner, and I'm here today with David Schwarz to really talk about financing and how to creatively get deals done in some tough environments. So, David, welcome and thank you for joining us.
Thanks, Brendan, for having me. I'm excited to be here.
Awesome. So I guess to kick things off, would love to hear a little bit about your background and kind of why and how you got into this line of business.
Yeah, absolutely. So, I'm born and raised in Texas, went off to Baylor, got my business degree up there. And my dad was in the real estate business for his entire career. And he was very instrumental in directing me to entertain the financing side of the business. So when I came out of school, I joined a firm called Live Oak Capital. And I initially got into the business with the hopes of becoming a developer, and then kind of as an analyst and seeing what happened in the financial crisis, realized that the risk reward on our side of the business wasn't such a bad thing. Live Oak was eventually purchased by BB&T Bank that owned Grandbridge. So we transitioned into Grandbridge Real Estate Capital. And then in 2014, David Schwarz with ARA reached out and was looking to sell their company to Newmark and wanted to grow a debt and equity shop. And so that was a good situation for us to align ourselves with a strong investment sales team, which was really the way the market was starting to head. So we made that move in early 2015, and it's been a great move for us. We're full service mortgage bankers. We are lenders for Fannie, Freddie, and HUD. And then we broker out to life insurance companies, CMBS, Wall Street banks, debt funds, and pretty much all the capital providers out there. So that's a little bit about who we are and what we do. We're a high volume shop. We've been blessed to put some points on the board over the last 10 years. So we're pretty much focused on multifamily, but we do a handful of commercial deals every year as well.
Phenomenal. Yeah, thanks for sharing that. And that's interesting. A lot of the folks that we talked to had some sort of parent or relative that started off in the real estate world. That must have been cool to grow up with and just kind of a natural path for you to take.
It was. My dad is a land broker, and so it was feast or famine. You kind of knew when Christmas time rolled around if it was a good year or if it was a down year. And so I think that was a big push why he wanted me to entertain the capital market side, because there are big swings in brokerage, and on the financing side, even when the market starts to slow down, there's still refinances and transactions that need to happen. Even if it's not a boom market, it still can help you to keep the lights on. So having been in the business now for 18 years, I can say that has proven to be proven true.
Yeah, and when we talk about really kind of the operations or keeping the lights on, I guess one decision that's critically important for the financing side, the multifamily world, is choosing the right financial vehicle for your investment. Can we start to talk about a little bit about the loan types, maybe like an agency versus a bridge loan?
Sure. Agency is a great execution. When people talk about agency, they're usually talking about Fannie and Freddie, although HUD financing is available as well. Fannie and Freddie offer both fixed and floating rate products. Right now, we're seeing a big wave of people refinancing or acquiring properties with fixed rate agency debt. The main reason for that is because the interest rates are lower with fixed rate right now. They offer 5, 7, 10, and in some cases 12-year fixed rate product. It's also a less risky vehicle. Typically, when you go under app, Fannie and Freddie does their best to hold proceeds throughout closing. They're backed by the government, so that's certainly a big benefit. And then they're really good at holding their spreads. You're able to index lock those deals early. So once you index lock, you kind of know, even though you might have a couple weeks before closing, that your deal is pretty much ready to go. God forbid there's no crazy blow up in the deal. So I think the agencies are really good execution in the market, not just now, but always. There's speaking to bridge, there's kind of two scenarios we think about when we're thinking bridge. One is with the debt funds, one's with the banks. Debt funds right now are chomping at the bit to do deals. They're a great execution, particularly for value add sponsors that are looking to go put, $5, $10, $15,000 a unit into a property to create value. Those are usually 3-year deals with 2 1-year extensions. It fluctuates a little bit. They're great for lease up plays as well. They're shorter deals, and you can usually have some flexible prepayment with those. The problem we're seeing with most of those deals right now is interest rates have just shot up so much. So, I mean, a bridge deal today, might be closer to 7 to 8%, where a year ago that could have been as low as 2. The banks are a great execution for bridge as well. However, most of the banks are on the sidelines. So we're hoping that they thaw out sometime soon, but a lot of our clients like the banks. They're usually a little bit lower leverage than the bridge, the debt funds, which can go up to 75, 80% loan to cost. Most of the banks are in the 60, 65, maybe 70% loan to cost range. However, they can do shorter term deals. They can do 1, 2, 3, 5, 7-year deals. They're a little more flexible, but they usually require a little bit more of a balance sheet from the sponsor to get those done.
Yeah, and correct me if I'm wrong too, but the bridge loan implies taking against equity in some other asset, correct?
A bridge loan is really a vehicle that gives you a little bit more of the benefit of the doubt on the growth of the value creation you're about to implement at the property. Okay. And so it'll help you capitalize capital expenditures. For example, if you're looking to add new appliances and countertops and repaint the project, and let's just say there's a couple $1 million of capital expenditures that you want to borrow against. That's really often the times that somebody will go seek a bridge loan, and then once they've harvested that value, they'll refinance or sell the asset.
Is there inherently just more risk with a bridge, like an asset that typically goes towards a bridge loan? When you say like value add, is that why folks typically lean that way versus an agency loan? Like, in what scenario would you prefer one versus over the other?
I think I would prefer a bridge loan in a scenario where there's true value add, and you have, your comp across the street, for example, has got $200 a unit or $150 a unit more. And if you go implement this strategy to kind of bring this property up to that property's level, and you can do that in 18, 24 months, maybe 36 months, I think that's a good situation for a bridge loan, particularly in a market where it can be a little bit more challenging to raise equity. If you have a big balance sheet and you do have the equity, you can do a similar product with the agencies on a floating rate basis. You're just going to have to put some more equity into the property. But they have flexible prepays as well. You can usually get out of those loans after a year on the floating rate side for 1%. So I would say for true value add player, debt fund or bank usually gives a nice vehicle to implement your strategy, and then you kind of look towards the agencies for a takeout. Okay,
and so one of the qualifications that you called out too there, or not qualifications, I should say, differences between the two is really the term. The bridge loan tends to be a shorter term, so that would impact ultimately your exit strategy, right? Because you're going to have to sell or refinance before the end of that loan. What other qualification differences would you say there are between the two loan types, if any?
Qualifications, I would say, every lender is looking for somebody that's, done this before, that's got a good successful track record. I would say if you're newer to the industry, it's probably a little bit easier to get a deal done with a bridge lender. Historically, today might be a little bit different than it has been in the past. Agencies are going to look very, very keenly at who you are, what your balance sheet looks like, who's managing your property. They're going to be a few more I's to dot and a couple more T's to cross. But that's a good question. We can usually find a home for just about anybody and any product if they've done this before.
Awesome. And so moving into kind of the rates, you touched on that a little bit, but can you talk about what you're seeing in terms of current rates and where they've moved in terms of comparison to maybe 12, 24 months ago?
Absolutely. So it's been a pretty wild shift. So if you're looking for an agency fixed rate loan today, you're anywhere from probably a 175 to 185 spread, which is resulting in a I don't know, a little over a 5 to 5.25 all in coupon today. If you're going floating, the spread's usually a little wider. Just call it 215 to 225, and those are anywhere from probably 6.4 to 6.6, depending on where the term SOFR is. For your bridge debt, we most of the deals that we're seeing right now are anywhere from 350 to 450 over term SOFR. So you're looking at 8.25, 8.5 to 875. So that's a pretty big rate, and a load to carry when your cap rates have gone maybe from 3.5 to 4.75 or 5. So that's really what people are focused on right now.
And so what are people doing to try to combat these higher rates? Like, because it's definitely a variable that has huge impact on what you're able to deliver to your investors. So what are people doing differently?
Right. Well, everybody, for the past couple of years, people have been required by most lenders to get a cap, buy a cap. And that's been saving a lot of people. Those that didn't buy an interest rate cap are probably entertaining that now, or trying to figure out what scenarios out there for them to protect themselves. As far as it's what people are trying to do today, they're trying to manage their NOI. We're seeing taxes increase, we're seeing insurance increase. So sponsors that have done this before and are good at what they do are navigating the waters pretty well. There's a lot of debt that's going to be maturing this year, and we're a little bit early, but I do think that there's going to be some pain with some groups that levered up to as high as they could go and have to refinance this year. So that'll be interesting. We'll see how that comes about. There are some groups. There's a lot of prep groups coming out to work on rescue capital and ways to help clients get through that. But it's definitely going to come at a cost. The other thing to keep in mind is if you had to go refinance a deal today and you did buy a cap 2 or 3 years ago, there's a very high probability that you're in the money on that cap rate. So we're doing some refinances right now where the client's going to be able to cash out, $500 to $1 million in just their cap cost, which has given them an opportunity to refinance at a make whole loan, but still distribute a little bit of capital to their investors.
So thank you for sharing that example. That's interesting. Like, I guess, what has it done in terms of change for your role and your job? Are people coming to you as more of an advisor to say, hey, what are some creative options that we have here?
Yeah, I'm in a special role. When times are good, I'm the hero, and when times are bad, I'm the bad guy. So, I would say a lot of people are calling us asking, like I was on a call with a sponsor yesterday asking specifically what I would do if I were him. It's always tough because we don't have the crystal ball, but what I tell most of my clients is if the deal works, make sure you have a little cushion. Go ahead and take what you have on the table. An example on a fixed rate scenario was a week and a half ago, Treasury shot down. That was a great time to lock. If the deal works for you and you're trying to lock rate, go ahead and do it. Don't wait for another dip or wait for rates to rise, because I think we've all seen how quick things can change in this environment. So I would say just be cognizant of working on deals that make sense. Don't try to time the market. It's very difficult to do that.
Mm-hmm. Yeah. And so are you seeing deals struggle at the moment, or are people actually locking those in, and are they pushing through?
We have most of the deals we're working on right now are actually very close to being able to refinance now that the treasuries have come back in. That's helped us a little bit, and spreads have come in. The agencies are trying to figure out ways to get creative to help people on their refis. They're entertaining 1-2-0 debt service coverages. They're entertaining 35-year AMs in certain situations. that said, it's not getting everybody to what they need. So in those situations, people are having to go back. I have one client who has a deal and they've done everything right. They're good operators, and they had to go extend their bridge debt by another year. And in order to do that, to hit their covenant, they had to pay the loan down a little bit. So they were fortunate; they were in a position they were able to do that. Later this year, we'll end up refinancing it, and hopefully, we'll be in a position where it's a make-whole loan or a cash-neutral loan. But there's going to be some people that that are in situations where they have to refinance this year, and they're going to have to decide if they're going to make capital calls to their investors, or if they're going to be able to come out of pocket, or if they're going to take some rescue capital in order to get those transactions closed.
And you might not be involved. I might be throwing you a curveball here, but are you a passive investor in any capacity? Have you had to deal with this on the kind of the other end of the spectrum?
I'm a passive investor. I have not had any capital calls yet, but it's something that I am certainly monitoring closely.
Yeah, that must be interesting, just knowing what could be coming downstream, being where you are in the industry.
That's right. Yeah, no doubt.
Yeah. So what do you think is going to happen over the next 12 months? Do you have any predictions, or feel like you have an understanding of where things might be trending?
Yeah, that's a great question. I would say I think we've seen a lot of shift already happen. We just got back from NMHC last week, which makes this timely. I would say coming off of that conference, I walked away a little bit more optimistic than pessimistic. I think everybody out there is sitting on a bunch of cash. They're ready to do deals. It's human nature to transact, right? So, I think we're all anticipating at least one more Fed hike of 25 bips. If that's it and we see rates stabilize, I think the second half of this year could open up some opportunities. One of the biggest holdups with transactions, I think, is going to be the sellers. We've seen cap rates go from 3.25, 3.5 up to, call it 4.75, 5%. So that's a pretty big shift when you were thinking about selling your property 6 months ago, and now you're entertaining selling it now or in the next 6 months. So I think if you have the ability to hold on to it for just a little while, and you're not quite to that return threshold that you were seeking in your pro forma, you might sit tight for just a little bit until you realize, okay, it's time to sell. I still think those transactions I think those will take a little bit longer, but there's still groups out there that have fund lives that need to sell, that have partnership reasons that they need to sell. And so I'm hopeful the second half of 2023, we'll see the market kind of free up a little bit. I just don't think it'll be quite to the same transaction volume level we've seen over the past, 18, 24 months.
Gotcha. Yeah. So in summary, sellers are hesitant because their expectations ultimately have to shift on what they can make on their property. And that's probably a tough pill to swallow.
That's right.
Yeah.
That's right.
So what would you recommend for someone getting started right now in this type of environment?
Somebody getting started on the acquisition side?
Yes. So sorry, on the acquisition side.
I'd say I'd be underwriting a lot of deals. When I got into the business, my dad told me from a principal side, which I've never really done, he's like, you're going to underwrite 100 deals to find one that works. I would say get very entrenched in underwriting as many deals as you can. I would make, a lot of brokers your friends. I think that I'd be patient. I wouldn't force a deal. The right deal will come. It's just, making sure that you have the eye to know what is a good deal and what is not. I'd align yourself with a good operator. I think now more than ever, the management side of the business is going to be a very important role in a successful transaction. And I'd be careful not to over leverage. I'd really try to figure out a way to take possibly a slightly lower return, and put a little bit more equity in the deal than I would, probably 12, 18, 24 months ago. I'd want to make sure I'm protecting my downside, and I would also focus on certain submarkets. I'd know my submarkets depending on where you're looking to buy, and I'd know my comps and make sure that your business plan is pretty sound.
So just even more attention to detail in a moment like this. And so with all that advice too, as a passive investor yourself, what sorts of questions would you be asking of those that you invest with, and what would you be looking for?
Good question. I would be looking for people I personally know well and trust. I'd be looking for people that are not looking to over leverage, and I'd be looking for business plans that I think are, very safe. That's what I would focus on. I probably wouldn't be looking for the oldest product and looking for such a substantial reposition, in a random part of town. If that was an opportunity in an infill location, that might be a very different story. But I'd just be focused on a business plan that makes sense for, for what I'm looking to be in a safe investment.
Great, thank you. And as we begin to wrap up, so I'd love to give you an opportunity just to share where people can find you and share a little bit about what sets Newmark apart as a partner.
Sure. So yeah, I'm based in Houston, Texas. I run the capital markets team with two partners. I think some of the things that set us apart from our competitors is our culture. We're very synergetic. We're all friends outside of the office. We've got an incredible investment sales team. I think over the past 5 or 10 years, we've probably sold between 55 and 60% of the Houston MSA for multifamily. And so we see a lot of transactions. Our capital markets team is underwriting every single one of those. We're very active. I think, my team has done about 10 billion over the last 2 years in multifamily capital markets, and our investment sales team has done, more than that, probably 13 or 14 billion. So it's been a pretty busy couple months. We know just about everybody out there. And I would say, I think we're a fun group to do business with. For us, it's not just about a transaction, but a relationship. In addition, Newmark's a full service platform that has, land, we do equity, we have office, retail, industrial. We're a global company. And so I mean, we're a full service national, real estate company.
Phenomenal. Well, David, it's been an absolute pleasure. I want to say to the audience, if you'd like to find more information as it relates to what David talked about, feel free to reach out to Newmark and his organization. You can look at the comments below for information on how to reach him. And then additionally, if you want more information on multifamily networking with people like David and others, and just general newsletters, check out momentummultifamily.com and sign up in the investment portal. Thank you, David, and I look forward to talking to you again soon.
Thanks, Brendan. Likewise. Appreciate you having me.